Thanks for checking out today's episode of the podcast. We have got a very specific focus. Today's episode, I'm going to be looking at our own HMO story. HMOs, shared houses, houses of multiple occupation. They're what allowed us to escape the corporate world. My wife and I, we've invested in a whole bunch of different types of property over the years, but in the early days, HMOs were the real focus for us. And like I say, it was those early HMOs, the income that they generated that allowed me, first of all, to step away from the corporate world, and then laterally Victoria to follow a couple of years later. So we have got a free training that we're running this week and next week, depending on when you're listening to the podcast. If you're listening to this at some point in the future, we may be hosting something similar again. So, check it out, head over to our website and you'll see what we've got going on. But specifically, this week, we are running our sort of annual introduction to HMO investing session. And I thought this would be a nice complementary addition to those trainings that we're going to be running, just to give people who haven't come across us before a bit of a background about the impact that HMOs have had on our lives. And I guess as a result of promoting this training, we have had, we've got a lot of new followers on social media. Instagram's where we hang out a lot. We've had a lot of new subscribers to our email list as well. So if you've not come across us in the past, this might just be a nice little introduction to us and a bit about our story as well. So I'm going to be focusing on, I guess, sort of the chronology of our HMO investing story. We had a bunch of questions through social media, through an email that I sent out to some of you that I'm sure you will have responded to. I've kind of tried to group them into broad categories as much as possible. So starting off with our background before HMOs, talking specifically about our HMO progress from start to, from our first project through to today. A lot of people were asking about when we quit and what our timeline was and what our roles are in the business as well. So we'll be talking a little bit about that. I'll be talking about funding, how we funded our first deals, how we fund our current deals, our future plans for HMOs, although a lot of that will be covered in the training that we're going to be running, the first one on Thursday night. And then a couple of questions that didn't really fit into those categories I've made a note of to answer at the end. So if that sounds good, hang around. I'll try to keep it short and snappy. And I want to start off with our background before we got into HMOs, just so you've got an idea of where we're at. So we've been investing for quite a while. My wife and I met on a grad scheme up in Newcastle in our early 20s, and we started flipping houses together pretty quickly. So we've been doing this now mid-30s, over a decade, but it was pretty slow to start with. We were still working full time, so property was very much a sideline. We were doing it evenings and weekends. We'd do one house a year, maybe even less frequently than that to start with. And then gradually it ramped up and up to the stage where now we're doing 3, 4, 5, 6 deals a year, depending on capacity and what else we have got going on. So we had a small amount of experience from doing a couple of those flips. We were based up in Newcastle, and we had a little bit of single let experience as well. I bought my first single let when I was 18 before I went off to university. And we had a bit of an idea of how to renovate a house, how to buy an investment property, one that wasn't for us to live in. But it was minimal. There wasn't a ton of experience before we decided to make that leap into HMOs. And I've worked with tons of people that have gone straight into HMOs without any prior single let experience or flipping experience. And I personally do not think you need to have a lot of previous property experience before you can get into HMOs. I think there's a bit of a misconception there. So we had a bit of experience just to, set the record straight, lay our cards on the table. We'd done a couple of flips. I had that single let. But HMOs were what we focused on when we decided that property was going to become more of an income for us rather than just a sideline alongside our day jobs. So then from an HMO point of view, our first HMO was accidental. We bought this in September 2009. This was up in Newcastle. It was a 3-bedroom flat, which is kind of uncommon for HMOs, but not the end of the world, not the worst thing that you can do. I lived in it initially, so I renovated it. I moved in there, moved in a couple of my friends who rented out the 2 spare rooms. I was kind of living for free because they were paying the mortgage and the bills. So that was a great place to be in. Then I moved out and moved in with Victoria, rented out the 3rd bedroom, and the 3rd bedroom, the income from that paid for our mortgage on our new place as well. So although it was accidental, we very quickly realized that there was a ton of potential to make income from HMOs, even this small 3-bedroom one, certainly compared to the single that I'd owned for a few years prior to that. So we kind of got bitten by the bug pretty quickly, despite it not being an intentional move into HMOs. Then we made the decision that I was going to focus full time on property. This is the condensed version of the story. But after a few years, I was fed up with corporate life. I wanted to do something else. Property was the route that I wanted to follow. And from our limited HMO experience of this flat, we thought, well, let's do more of this. So this tied in with us leaving Newcastle, moving to Manchester, where Victoria is originally from. And we bought our first intentional HMO in May 2015. So 6 years after that accidental HMO. So like I say, some of this in the early days, there were big gaps in between what we were up to. And that first intentional HMO was a residential house. It was a 2-bedroom semi-detached property in South Manchester, where we pretty much exclusively focus our investing now. And we turned that 2-bed semi into a 6-bedroom HMO. So it's had a cellar conversion. It had a loft conversion. We put a 1-story extension on the rear to make the ground floor living space bigger. We've got 2 bedrooms in the loft. We've got 3 on the first floor, and then we've got 1 on the ground floor. And that was our first intentional move into the world of HMOs. And that generated for us in excess of £1,000 a month from day one. It's usually about £1,200 a month on average that has made us over the last, 8 years, from one house that was a 2-bedroom semi. Now, things have changed a little bit. Mortgage rates, thankfully, we haven't had to refinance this one yet. But I'm aware mortgage rates have increased. Utility bills have increased. Like, there are things that are happening in the market now that have changed the income potential of all investments, but specifically, with HMOs, usually you've got big mortgages on them. Usually you're paying for the utilities. I'm going to be covering this in the session that we're running in a couple of days because it is an important part. But the income is so big on these. Even if that £1,200 a month has come down slightly, it is still a great profit from what was a relatively cheap house for us. So that was 2015 that we did our first intentional HMO. We did a couple more sort of residential to HMO conversions. And then pretty quickly we got into commercial to HMO conversions. So our first large HMO, which became a 9-bedroom shared house, was bought in August 2017. So only a couple of years, 2.5 years or so after we'd bought our first, maybe even less than that, maybe 2 years after we'd bought that first intentional HMO, did we then say, well, let's go and look at sourcing deals through other avenues rather than just looking at resi stock. Let's go and buy an old office building and convert that into an HMO. So that was a big step up for us. We had a bit of income, we had a bit of experience, but we'd never done a commercial conversion. But the bigger building, the bigger floor areas allowed us to create this really nice bespoke HMO with big bedrooms, pretty much all en suite, huge communal space for them, shared living space. And we were, thrilled with the outcome of that. Despite us actually, first of all, we applied for planning to convert it into a 13-bedroom HMO. With hindsight, we realized that was overdevelopment. I'm kind of glad that planning was refused because it's not always about more bedrooms. The spreadsheet can lie. And what looks good on a spreadsheet doesn't always run well in practice. So actually less bedrooms has resulted in higher occupancy rates, higher rents, all the stuff that leads to a more profitable, easier to manage HMO. So 9 beds is a good, 10 would have worked, but 9 beds I'm happy with. And that one generates us over £2,000 per month from one single property. Now that's a joint venture. I'll talk about how we funded our deals shortly, but what that means effectively in this case was that somebody else put in all of the money to buy the property, to renovate it. We did all the work. We sourced it. We managed the renovations. And then we split the income on that. So we own the property 50-50. And of that £2,000 monthly profit, we get £1,000 and they get £1,000. more or less. Now, there are lots of different ways that you can structure joint ventures, and there's lots of different ways that you can interpret numbers. When I'm talking about the numbers here specifically, I'm talking about our sort of pre-tax profit. So our rental income, less all of our costs, our mortgages, our utility bills and everything, but pre-tax, because everyone's tax situation is different. So that £2,000 that we make on this large HMO, the £1,200 that we made on that first HMO, the first intentional one, we had tax to pay on that, but that was net of all of our costs, just to give you a sort of clear idea of what we are working on. So our HMO progress, that was back in 2017. Since then, we've done a bunch more, predominantly commercial to HMO conversions, a few residential HMO conversions. But, we really sort of liked the scope of buying commercial property and converting them into HMOs. So that's been a lot of our focus since then. And how that translates into when we quit our jobs and what our sort of timeline looks like. So I made the jump before we even had that first HMO secured. So when we left Newcastle to move to Manchester, we had made the decision at that point that we could live off one salary. Victoria was going to stay in the corporate world and fund our investing, fund our life effectively, make sure that we could pay our bills and our mortgage and all that stuff. And keep us mortgageable as well, which is super important when you're in the early days of investing. Banks are going to want to know that you've got an income so that they will be happy to lend to you. So she was going to stay in the corporate world, and I was going to go and focus full time on the property business with a view to building up our income so that she could then leave. So, that was the decision that we made. We knew we could get to our goals a lot quicker if at least one of us was working on it full time. And, that reality of the situation it kind of played out exactly as we expected it to. Now, caveats. We were relatively young still. So we knew that if something went wrong, we could bounce back. I could go and get another job. We didn't have any dependents. We didn't have any kids. We didn't have any elderly parents that we needed to look after. So we were kind of not carefree, but we were in a good position where we could do this. Everyone else, your own circumstances are going to be different. You may want to have more of an income behind you before you decide to quit. You may never want to quit your day job, right? Like some people love what they do, but they just want more income. So property can be a good sideline, and it can be run alongside other things as well. But we were young, relatively carefree. We made this decision that, we could reduce our sort of living costs. I'll focus on property, get to our goals quicker because I've got that full-time focus. Victoria keeps us mortgageable. And then once we build up the income, she could then step away as well. And we would both focus on our business full-time. So then Victoria, so that was 2014, we sold our place in Newcastle. 2015, we bought that first HMO in South Manchester. She stayed in the corporate world until 2017. So, 2.5 years or so. And by that point, we also had a couple of years of accounts showing the income from our first properties. We had a bit of additional income as well from property management that we were doing for ourselves and then offering to sort of friends and people that we knew in the industry. It wasn't big sort of public letting agency, but we did manage properties for other people and we got a bit of an income from that. And the project management, we would kind of do what we were doing for ourselves, but for other people because we had limited cash, but I had quite a bit of time. I was running one project for us and then I'd maybe be running a project or two projects for other investors and getting a project management fee from them as well. Building my experience and also creating a bit of an income for ourselves whilst we were waiting for the income from our portfolio to grow. So it only really took 2.5 years to get to the stage where Victoria then made the jump into full-time property investment as well. So 2 to 3 years from the decision being made to us both being out of the corporate world, which we were thrilled with. And, I still think that is a great success. If you're unhappy in your corporate job, if you'd like to be a full-time property investor, the prospect of being there in 2.5, 3 years, 4 years, 5 years even, I think that is a short enough time frame of a sacrifice that that should hopefully get you fired up and show you the potential that I could be doing something that I love within 3, 4, 5 years. I think that'd be a great place to be. So, like I say, we sold our place in Newcastle September 2014, moved to Manchester. 2015, we bought that first intentional HMO. So we had the unintentional one up in Newcastle. By 2017, Victoria had left her job. And by that stage, we had 2, maybe 3 HMOs up and running. So like not a huge portfolio at all, but with the numbers I'm talking about, £1,000 a month, £1,200 a month, we didn't need a huge number in order to get to a stage where we could live off the income from that portfolio. So I think, by the time Victoria was leaving, we maybe had the income from 3 coming in. I know we had the offer accepted on the commercial to HMO conversion. We knew that would generate us another £1,000 a month. So we had, we had future income that was sort of in the bank because the offer had been accepted and conveyancing was progressing on that one. So we were maybe up at, potential income of £4,000 a month or so within the space of those couple of years. And as I said, we had some additional income from project managing those projects for other people and managing a few HMOs for some friends and some contacts as well. So we were in for us a pretty good position, and we were happy at that stage that we would be able to live off the income that we had generated and continue to grow our portfolio. So we had, as I said, no kids. We owned our own home. So we weren't in the stage where we needed to refinance at any point in the near future. We knew we had a couple of extra years before we need to refinance and then have our own SA 302s or whatever we needed to give to the lender to refinance the house if we wanted to. And I think the most important thing was that we had the belief that we could do it. We weren't relying on, anyone else to tell us that it was possible or to support us along the way. It was this internal desire and this hunger to make it work more than the lack of other commitments, more than the experience that we had. We wanted to work for ourselves, to be self-sufficient, to create time freedom in our lives. And it was that hunger, I think, that really pushed us forwards. So that's the kind of high level time frame that got us from our first deal through to the stage where we were able to leave the corporate world. And then both of us really aggressively focused on continuing to grow the portfolio for a couple of years before we decided to go and sail around the world for a couple of years and then have kids. And, plans have changed. But early days, there was that real desire there, and it kept both of us super excited, super motivated to just keep growing it and growing it and growing it in those early days. From a funding point of view, first couple of deals was our own money. So we had some money saved up. We had Victoria's income. We had some of the profits from some of the flips that we'd done up in Newcastle, and we did a couple more flips when we came to Manchester as well. So we did a few flips alongside those early HMOs to replenish the pot. So it was like do an HMO, get the income from that, then do a flip, replenish the cash pot, put that back into the next HMO, and so on and so forth. So that was the first couple of deals. Personal loans, 20 grand personal loans at 1-2% annual interest, unsecured through Sainsbury's Bank or whatever, some credit cards. So, but it was just scrappy. Let's pull the money together that we can. Let's do what we can. And let's fund them ourselves to build up that experience and that track record. And at this point, I didn't really know about private finance and the options that were available there either. So we kind of didn't really know any better. Then, we used the first time we raised any private finance was on a debt basis. So a loan for a fixed return on one of those early HMOs, one of the first ones that we did in Manchester. So we had a little bit of experience, but not a huge amount. We borrowed £40,000 at 20%. And I kind of cringe saying that, but equally, I'm glad that we did that because it opened up doors to a whole lot of different stuff for us. It's a huge amount of interest to pay. It's not what you need to pay in interest, but, as I said, I didn't really think investing in us was something that anyone else would consider. So I made this absurd offer thinking, well, everyone's going to turn us down. And a couple of people came back and said, yeah, I'll lend you the 40 grand at 20%. So that ended up costing us £8,000. But the alternative was not borrowing that money, not doing that next HMO, not making another £1,000 a month. So that 8 grand was paid back within 8 months. And over the 5, 6, 7 years that we've owned that HMO, we've made far more than that back. So we used debt after our first couple of deals. And actually from there, that first commercial to HMO conversion that we did as a joint venture. That was with the investor that loaned us that £40,000 at 20%. So that was then an equity setup where we both own the company that owns the building and we split the profits 50-50. But that was only really possible from the connection that I'd made with this investor as a result of doing the debt-based investment. So it kind of started to snowball from there. We realized that people were interested in investing in property generally. So we borrowed money on a debt basis. We did a couple of joint ventures, and the portfolio started to grow beyond the funding that we had available. I think that's an important point to make. Like, you don't need to know how you're going to fund deals 6, 7, and 8. If you know how you can fund deals 1 and 2, I would get started with deals 1 and 2, and then options will open up to you. The path will become clearer as you make your way down it, as it did for us. If we had thought, oh, well, you know what, we don't know how we're going to be able to fund our 4th HMO just yet, so let's not start, we never would have got to the stage where after deals 2 and 3, we were like, wait, hang on a minute, people might be interested in working with us, and then raising the funds. So it was only by getting started that the route to the sort of future success, future progress became clear to us. And in terms of something else, a question that came up quite a lot in terms of funding was, how much money do you need? It's something that I will go into more detail on in the training series, but it's going to be dependent on where you're investing. Obviously, there's a big range in house prices between central London and Newcastle, where we started off investing. So the location that you're investing in will have an impact on that. What you're buying will have an impact on that as well. Are you looking to buy a 2-bedroom terraced house? Are you looking to buy a big office? Are you looking to buy a 6-bedroom detached property that you can build another house in the garden? Like, all of these things will impact the amount of money that you need. And also the amount of work. Like, what does that project look like? Is it a big renovation? Are you going to extend it? Or are you buying like an existing HMO that you can just maybe give it like a paint and move new tenants into? So it is difficult to answer the question of how much money you need, but as a bare minimum, I will say sort of around 50 grand. That gives you enough for a deposit and a very light renovation. If you're investing in more expensive areas, if you're looking to buy larger properties to get started with, 50 up towards 100 grand is probably enough to get started, keeping in mind that you can use maybe mortgages or certainly bridging finance to fund a lot of the purchase and some of the works. But that 50 to 100K as a benchmark of your own available capital should give you enough to do your first deal. And then, from there, hopefully you can refinance some of that money back out. You might be able to look at other sources of finance. Maybe you've got equity in your own home. Maybe you could go and get a 20 grand loan like we did. Maybe you and your partner can get a 20K loan each, and then you've got 40K to go at. So there are ways that you can replenish that pot, but sort of 50 to 100K is the sort of minimum entry point, I would say, for a successful HMO. It can be done with less. You could look at options like rent to rent and things like that, but it's not really what we focus on. It's not what we talk about. So to go out there and buy an HMO, to give it at least some TLC, I'd say 50K as a sort of minimum baseline. You could probably do it a little bit cheaper, but that gives you an idea of the sort of, ballpark figures that we're talking about anyway. So yeah, that gives you a bit of an idea about funding. And then in terms of, more recently, we're still using our own money where possible. We're still using investors on a debt basis, so loans that we give them a fixed interest on. We're still working with people on a joint venture or an equity basis. But property goes up in value as well. It goes up and down, but over the long term, it typically goes up. So what we have seen is, like some of our earlier projects, one of the first ones that we bought for £95,000. It's now worth, so we bought it for 95. We spent about 60 on the renovations. So that was like 155 all in. And then we got it valued at about 180. So we got some of our cash back out at the time, but it's now worth about £300,000. That was over the course of 6 or 7 years. So in that time frame, it's gone up in value by another £120,000, not because of the work that we've done, but just because of capital appreciation. And, it's therefore a potential source of funding for us. Like, we could have refinanced that twice in those 6-7 years, pulled out 60 grand each time, and that would have been a deposit for another house each time. So we could have bought another 2 HMOs as a result of the capital appreciation, the increase in value of that house from when we bought it. So like I say, as you go, getting started is definitely the biggest barrier to entry. once you're in the game, everything does get easier. The route to the next deal will become clearer because you've got more experience, more contacts, a better idea of what your next project looks like. So just focus on the next 1 to 2 deals, and then that route will become clearer for deals 3, 4, 5, 6 as you get down the line. In terms of our future HMO plans, so a big part of this is obviously, what's going on in the market just now. Interest rates are going up, inflation, utility prices, all that stuff. I'm going to be talking about that a lot in the first session. I was talking about our future plans for HMO investing. So, there's a lot going on externally in the market just now that I think has got people worried. There's still opportunities to invest in property. Is it a good time to invest? I'm going to be covering that in a lot of detail during the first part of our training series. So if you want to dive into the details on that, I'd suggest that you join us there, and we can have a conversation about the current state of the market and how that impacts the potential for HMO investing. But generally speaking, we're still pretty bullish on the market. I think there's a ton of opportunity. We've diversified our portfolio a lot. So although this is focused on HMOs, and that's how we started off with our serious investing and what got us both out of the corporate world, we have started to diversify. We've started buying more single lets. We've got some service accommodation. We keep some commercial stuff as commercial rather than converting it all into residential. But HMOs are still absolutely something that we are looking at as well. And they will continue to be for the future because I see so much demand for them. And I know that we can service that demand in a good way that also generates us a nice profit. So yes, they will continue to be a part of our investment in the future. Our focus really, I think, will continue to be mainly on commercial to resi opportunities, creating larger, 6 to 10 bedroom HMOs. I think that's where the real sweet spot is for us. But there are still opportunities at the smaller end of the market. You can absolutely go bigger than that. You don't need to be buying commercial property, residential houses to HMO conversions. We got a ton of examples of people that we've worked with in the past, people that have been on the podcast recently. There's examples of lots of people that are buying houses, converting them into HMOs without needing to complicate it with commercial to resi stuff. It's just what I like to do. So that's our strategy. But yeah, HMOs will continue to be a part of what we do for the future. Other stuff that we'll be covering during the free training. So like I said, the current HMO market and how that fits into the wider economic uncertainty that we're seeing just now. Session 2 is pretty much all around how you can identify the ideal investment area for you, the best area for you to invest in HMOs. And it is a personal thing. So it really is focused on your best investment area. We'll be talking about things like students versus HMOs and the different sort of tenant demographics that you can go after serving. How much you need to get started. We'll go into that in a bit more detail, more personal to you as well. And what the different steps of the process are to, from setting goals for your HMO portfolio to finding your first deal, getting it through conveyancing, renovating it, and then the ongoing management. There's a lot of pieces of that puzzle that I'll break down for you as well in the training. So we'll go into more detail if you're interested, but this is just a nice little teaser of what's happened for us over the years to help you understand if you think HMOs are the right approach for you. Now, I mentioned that there were a few questions that we had from some of our social media followers, people on our email list that didn't fit into these broad categories. So I wanted to run through a couple of them just to wrap us up. So first of all, from Erica. Erica had said, actually, there's 2 questions from Erica. I wonder if you had to make any short-term sacrifices to reach your long-term goal. I think, maybe the broader question there is this easy? And I know that's not what Erica's getting at, but yes, absolutely. There were sacrifices, as there will likely be for you as well, unless you've got pots of cash and you've got tons of free time where you can use your money to bring in all the help that you need. There is going to be some additional work in the short term in order to create this new life that you're aspiring to create in the future, whether that's financial freedom, time freedom, location freedom. You're going to have to put in more work now to get those benefits in the future. In our case, it was, a lot of time reinvesting the profits. So yeah, okay, on paper, we were making money, but all of that was going back into future deals whilst we were living off Victoria's salary. And then laterally, we were living off income from some of our portfolio, but the rest of it was going back into the renovations. And, to this day, sometimes it still is. We've got money coming in, but we've got money going back out as well. So I suppose that cash flow management and seeing the income on paper versus the income that you actually take home, there's a sacrifice there. There's also a sacrifice in terms of the time. We wanted to create more time freedom, but in the short term, that meant less time freedom. We were working evenings and weekends in the early days because that's all the free time we had alongside our day jobs. We were getting our hands dirty and doing a lot of the work ourselves to try and save costs, but it was all worth it in the end. And it may be a sacrifice for 2 years, for 5 years, for 6 years. But if we're thinking about property as a long-term investment and you want to make some meaningful change in your life, like if you're in the corporate world and you're saying, oh, you know what, I'm going to get promoted maybe 3 years from now. Okay, well, that's great. If you're happy with that sort of time frame, think, well, actually, I could step away from my day job in 3 years and not need to worry about a promotion because I've created an income for myself. I think that's 3 years equally well spent. Not the right answer for everyone. But I think we make a lot of decisions, or some decisions are pushed on us in our lives that are kind of out with our control. And we think, oh yeah, well, 5 years, I'll get a promotion and a pay rise. Great. And like that, we just accept that, but you can actually control that for yourself and create a better position for long-term future by making some short-term sacrifices just now. So yes, there were challenges. Yes, it was tough at times, but it was absolutely worth it. Erica's second question: did any mistakes you made result in an unsuccessful HMO or property investment? So we've not done anything so bad that we wouldn't do it again. There's no deals that have gone like that don't make a profit, or that make such a little profit that it's not worthwhile. Property, again, is a long-term investment. Time is a great healer of mistakes that you make. We've done some stupid, like I picked some bad color schemes when realistically Victoria should have done that because she's got a far better eye for design than I do. So know your strengths and know where you need to get help. We made some mistakes with some of the renovation works, like on one of our early larger HMOs. It was the first time that we needed to put in. So you get different grades of fire alarm systems, and I put in like a standard residential fire alarm system. And you know what? Now we wouldn't do that. At the time, it was like, oh, this is catastrophic. It's going to cost us. But there's always solutions to these things. And after 6 months and you've got your tenants in, they're never as bad as they seem on paper. So yeah, we have made mistakes. But we went into it with a clear idea of the market that we were trying to serve, the area that we were investing in. Like we had all the fundamentals taken care of. So yeah, we made some stupid mistakes, but our investment strategy was sound. So we've never done anything, like we didn't go into anything blindly and result in something that was like so catastrophic for us or our business. We've made mistakes, but thankfully nothing so bad that we're thinking, God, I wish you'd never done that. Everything's a learning experience. And actually by getting started, you learn so much as you go that, if we weren't willing to make those mistakes, we'd probably still be in the corporate world. It was only by making those mistakes, by being willing to figure stuff out as we go, that we got to the stage where we did. A question from Neville: I see lots of potential areas which would provide a good ROI and great yield, which is great, right? Because a lot of people, they're like, I don't see any properties that are available. Like there are deals out there. So Neville, the fact that you can kind of already see them is a great start. But historically, you don't see much capital growth. So that's quite common, right? Like in, down south, general broad terms, you would probably get more capital growth and maybe a smaller or lesser yield. Up north, if you like, which is kind of ironic for me coming from Scotland to talk about England is up north, but you know what I mean. You'd maybe get less capital growth, but higher yields. So sometimes you have to make that trade-off, but you can get both, and it's not always a north-south divide. But anyway, go back to Neville's question. When starting out, what was our criteria to ensure you got all three, and how has that changed as you've progressed? Well, we didn't look for all three. From an HMO point of view, we were very much looking for income rather than capital appreciation. We've had capital appreciation, but that was a byproduct. It was never our intention. So we focused exclusively on the income and on the return on investment. That's the main thing, the main number that we assess, more so than gross yield or net yield. I think the ROI is a more valuable number. And we aim for a minimum 20% return on investment, which basically means that we're getting our cash back within 5 years. A 25% ROI would mean you're getting your cash back within 4 years. A 33% ROI would mean you're getting your cash back within 3 years. So we're pretty happy if we know that, okay, it's going to have 50 grand left in it and we're going to make 10 grand a month, 10 grand a year profit. Like, we would be happy at that sort of level. So we're 20% ROI is our minimum. We often get more than that. Sometimes we get 100% ROI or an infinite ROI, which means we've got all of our cash back out. So it's kind of positive from day one, but anything from a 20% plus ROI. And some people will be happier with 12%, 15% because they're investing in an area with higher capital growth. So they know that they'll also get the upside on that as well. But where we were investing, there wasn't huge capital appreciation. So it was very much, let's focus on the income rather than that capital growth. And then I think this is maybe the final question that I wanted to cover separately. Some of the other ones I've parked for sessions during the week because they fit more into that. But Sam said, how did you get over the hurdle of procrastination and get stuck into your investment goals? I think this is an important question. Like, how did you get started? Like, how did you make that commitment? Or, as Sam said here, get over the hurdle of procrastination. It comes from having that desire that I spoke about earlier, like a hunger to create change in your life. If you're super comfortable where you are, you're probably not going to be willing to put in the time, the effort, the blood, sweat, and tears to get where you are. So there needs to be a real powerful reason why you are doing this, to create some change in your life, to create some freedom, usually in one of three categories: financial freedom, time freedom, or location freedom. That actually, when you wake up in the morning and you think, am I going to get out of bed and put in the extra hours, put in the extra graft? It's a weekend, it's a bank holiday, I'm tired. Like, that reason why needs to be a powerful enough driving force. And if you find yourself procrastinating and not making the effort that you need to in order to achieve the results that you want, then maybe you actually don't want that result enough. There's not enough of a driving force behind you to get to that stage. So, the reason I raised that is because we're going to be doing a sort of an additional bonus session aside from the HMO training over the next couple of weeks on sort of goal setting, which will be taking place on Sunday. So we'll talk about that in a bit more detail there, but it all comes back to your driving force and your reason why. And if that's powerful enough, then, that will get you out of bed. That will get you over the procrastination. So that's all I wanted to run through today. Just a couple of details on the HMO training that we're going to be running if you're listening to this pretty close to release time. So it starts on April 13th, running through until next Thursday. So April 20th, we got 3 different sessions on the HMO model and market, and then a couple of little bonus sessions on things like goal setting, just to kind of help you understand what your plans might be and how that ties back to the HMO strategy. So you can register for free. You can do that at insidepropertyinvesting.com/HMO. I think I'll put the links below this video, or if you're listening to this on the podcast, I'll put it in the show notes as well. But I'd love to see you there. We'll have time to answer more of your questions, but hopefully this was helpful just to give you an idea of how we got started, what our HMO journey looked like. So thanks for listening. I'll talk to you soon.